All right, let's first move to our first chapter, an overview of a financial management. Let's start taking a look at the organizational structure of a corporation. Well, you see corporations everywhere. You see Nike, you see Coca-Cola, Ford. So what made up the staff and personnel of a corporation is the following. If you look at this hierarchy tree, you will see on the top of it, you got a board of directors. So board of directors is usually consist of 5 to 10 people. So these are the top people of a corporation. These directors are usually elected by the owners of the corporation. Okay, so the owners are the shareholders of a company's equity. No matter how small share you have for the company, you are an owner of the company as long as you hold the shares or stocks. Okay, so these board of directors are selected through a democratic manner. But the thing is, the board of directors do not meet every day. Actually, they meet just like every quarter or every year. So what about the daily management of the corporation? They would handle the management job to the general manager, which is the chief executive officer, the CEO, as we already heard. Okay, so the CEO basically is the general manager for the daily operation of the firm. Under the CEO, you have the COO, Chief Operating Officer, and you have the CFO, the Chief Financial Officer. Okay, the operation is like the muscles and the bones of a human body, and the finances of a company is like the blood of a human body. Okay, so you have a muscles and bones, you have a blood circulations. So the finances are pretty important. Without the finances, without the cash flows, just like the human body is going without blood, without oxygen. Of course, the human cannot survive without blood and oxygen, just like a company cannot survive with finance. Okay, so on the operating side, you have a marketing department, you have a production department, human resources for hiring and firing people, and also you have a sales department, so on and so forth. On the financial side, you have a also a lot of departments who handle accounting, spending, credit, cash budgeting, capital budgeting, and also investor relations, who is in charge to disclose the company finances to the public. All right. If we take another closer look, so from the board of directors, you got a CEO, you got a CFO. Then we further divide the CFO's job into two parts. The first part is the treasurer office, and another part is the controller. The treasurer basically is in charge of spending money, receiving money. Okay, so since the money could be in the form of cash or in the form of a credit, you have a cash manager and you have a credit manager. And of course, the company will spend a lot of money to launch a new business, to acquire an existing firm. So that is referred as a capital expenditure. And of course, the company will do a daily financial planning in the short run. Okay, and the controller is in charge of information. Okay, controller's job is information. They take care of the tax and they take care of the cost of accounting, financial accounting, managerial accounting, and they consolidate all the accounting information into the data system, and then they disclose the information to the owners or to the public. Okay, once again, the controller handles the collection, consolidation, and dissemination of financial information, and the treasurer basically handles the spending and receiving money. All right, so our next subject is the major legal form of organizing firms. The first one is called a sole proprietorship. It is a business owned by one single person. Okay, and sometimes it is called an individual business. The second form is called partnership. It is a business owned by two or more people. Okay, so you have two or more owners for the business. One could be a financial partner who contribute the capital, contribute the money. Another could be the general manager or general partner who contribute the managerial skill or contribute the talent for the business. Okay, so between the partners, they have to sign a binding legal arrangement. Okay, and the firm's income is allocated on a pro rata basis. Okay, so when the company makes money, the profit will be distributed according to the shares or the equity of each owner. Okay, so if you have 50% of the company's equity, you get half of the profit. If you got 30% of company's equity, you got 30% of profit. Okay, the thing is, when the partnership is firstly formed, um, you don't have to contribute 50% of the capital in order to get a 50% of equity. Okay, you can start with zero, but you got all the talent and all the skills and all the managerial and financial skills. You can be a important part of the partnership, and you can basically get a 50% of the ownership or the equity of the company when you contribute no financial capital at all. Okay, when the firm makes money, when you have a 50% of the equity, then you should get 50% of the profit. Okay, when you are having a sole partnership or partnership, there is no corporate tax because you are not running a corporation and you pay income tax. You guys should be aware that the corporate tax is not necessarily higher than income tax percentage wise. And sometimes, if you're running a partnership and if you make $250,000 a year, your income tax at percentage is actually higher than a corporate tax rate, which is usually at 34%.